a bit of a tug of war going on in the real estate market. And also, there are some investors re entering the market. There's some investor stats that might surprise you. We're going to talk about all of that today. So, the lock in effect, it's hitting home buyers and it may get worse, according to this article. So, they're talking about that this survey recently done found that Americans expect mortgage rates to climb from just under the 7% that they are now to 8.7% a year from now and 9.7% in 3 years. That's the highest recorded since the agency started asking Americans that question about 10 years ago. Now, the pessimism around this, they're saying, is obviously not going to change what the Fed does, but you can think of this in two ways, right? So being pessimistic about it could mean that a lot of people are not out there willing to buy homes and transact in the real estate market. But it also could mean the opposite, that if you truly believe that rates are going to be that much higher in the next 1 to 3 years, it might make more sense to act now versus waiting, right? So they're talking about how it would make little sense to start a house search if you believe interest rates will be unacceptably high and you won't be able to afford a home. However, if you believe rates will be 2 to 3 points higher in a year or two, that could make current rates look much more attractive, could weigh favorably on one's decision to buy in the short term. But the perceptions of higher mortgage rates might further lock in homeowners who have sold their homes or who would have sold their homes if not for the interest rate that they secured on the home. So that's what this article is talking about, is that, for all of those homeowners that we've talked about many times that have that 3% interest rate, it just really doesn't make a lot of sense for them to sell and buy something that's going to be more expensive, both price-wise and rate-wise. Now, we talk about the tight inventory. They're saying this is leading to soaring housing costs. None of this is new news. We talk about this very often, the affordability challenges and that lock-in effect being one of the biggest reasons. They're saying that new listings in cities that Redfin serves are up 10% over 2023. It's still far below 2022 and 2021. And I've shown those inventory charts on my channel before. They're here in Phoenix, same thing. We are seeing inventory climbing, no doubt. But when you look back historically to those years before the pandemic, we're not at those levels yet, or we're just getting close to that, where we had a little bit more of normal inventory. Inventory has really only gone down since 2020. So even though we're seeing this tick up, it's still not helping the cause all that much. I talked about this not too long ago too. There was a survey saying 40% of renters put the odds of them ever owning a home in their future at 40%, which is down from 44% a year ago. And those renters expect rents to go up about 9.7% in the next year, higher than the 8.2% predicted last year. So overall, consumer sentiment is quite low regarding the housing market, whether you're a renter or a buyer. And further, 38% of homeowners say they don't believe they could afford to buy their own home if they were purchasing it today. And that's a little concerning. Now, we have this kind of tug of war between these different generations, which is kind of interesting. We've got our baby boomers, millennials, and Gen Z are also entering the housing market as well. And this report from Redfin earlier this year found that the length of time people stay in their homes has doubled since 2006. It used to be about 6.5 years in your home, and now we're seeing about 13.4 years in a home. 56% of baby boomers have lived in their home for at least 10 years. That's not a surprise. I would say 10 is minimal for baby boomers. Most of the time they're there 30 plus years. 35% of Gen Xers have lived in their home for at least a decade, and just 7% of millennials have stayed in their home for 10 years or longer. So they talk about that the houses that do come up for sale are increasingly in need of renovation. So the point being, people are staying in their homes a longer time. I think interest rates that they got that were lower are a big factor in that. So they're not as willing to move. So they're staying in these homes longer. And the ones that do come up for sale need a lot of renovation. 73% of baby boomers have been in their current homes for 11 years or more, and over half own homes built in 1980 or earlier that have never been renovated. So we're seeing a lot of inventory that hits the market needing a renovation on top of the higher price and the higher rates. So this makes it even more difficult for buyers out there, because if you're not willing to do a project, or if you don't have the budget to do a project, once you put your down payment down and factor in what that mortgage is going to look like, it's really hard to find anything that's suitable for you. Now, along the lines of inventory, this article from Redfin is saying 1/3 of houses for sale are newly built, and that's just shy of the record high. So 33.4% of single family homes for sale in the US in the first quarter were newly built. Not much change since the year earlier, but it's down from a record high of 34.5% 2 years earlier. Now, why is this? Well, we've been building a lot, trying to keep up. Newly built homes have taken up an outsized portion of inventory since the pandemic. Home buying boom sent builders into overdrive. Two main reasons: home building has shot up. Construction of U.S. homes has soared at the start of the pandemic. Builders are responding to that demand and rock bottom mortgage rates. And these single family housing starts are still at higher levels than pre-2020. Now, we've looked at those numbers for Phoenix, and what's really striking is the number of permits and new building going on for multifamily, much more so than single family homes. They also say the supply of existing homes for sale has dropped. Homeowners are staying put because mortgage rates hit a 2-decade high. They're elevated but far above pre-pandemic and pandemic levels. And many would-be sellers are opting to hang onto their low rate than moving. We've talked about this, the lock-in effect. So supply of existing homes has dropped, and we've seen a lot more home building take the place to try to take the pressure off the resale side of things so that there is enough inventory for people to buy. So speaking of rates, what is going on with rates right now? And then we're going to talk a little bit more about these investors entering the market. So mortgage rates are actually higher this week. This was as of last Friday. Largely, it was a dull week for financial markets, but there was a lot of speeches from different members of the Fed, and that commentary changed things a little bit. We're not in any significant difference, it doesn't sound like, but basically these various Fed officials have said a lot of things indicating that they aren't going to cut the rate, or if they do, it's going to be maybe one time this year. So the large increase in market rents during pandemic may keep housing services inflation elevated for a while. The Fed will need to allow tight policy to have further time to continue to do its work. Inflation was disappointing. It did not provide the confidence needed to ease monetary policy. These are just a few. I expected 3 rate cuts. I don't think that's still appropriate. And I need to see several more months of good inflation data before being comfortable to support an easing policy. So overall, no one has confidence that they are going to cut rates this year multiple times. And if anything, it sounds like it could be one time, and that probably wouldn't even be until September. So on the news of a lot of that and different things that took place in the markets, we saw rates go up a little bit. So I always say it, if you're buying a home, just make sure you're hearing from your lender. Make sure you're checking in with them if they're not checking in with you, and you have a good idea of what's going on with the rate that you're able to get and how that affects your payment. And by the way, if any of this is helpful for you guys, make sure to hit that like button. I would appreciate it. And you can always subscribe to be here with us every Tuesday. So are investors re-entering the housing market after a 2-year retreat? Well, it sounds like it. They're kind of launching a comeback, according to this article. And it's interesting because they're talking about the differences between those mom and pop investors and the institutional investors. Purchases by investors grew 0.5% on a year-over-year basis in Q1. That was according to Redfin. And it goes on to explain how they define who an investor is, how they get that data. So despite the increase, investors have yet to return to the pandemic era levels of a purchasing frenzy, and they aren't likely to with interest rates remaining elevated. Now, the real estate investors bought 44,000 U.S. homes in the first quarter. Among the homes they're selling, they're reaping bigger profits. So I thought that was interesting. The typical home sold by an investor in March went for 55.2% more than the investor bought it for. That's up from 46.3% a year earlier. So although this has been a slower time, it's been maybe a little bit trickier to invest, a little bit more uncertainty with what the market's going to look like, a lot of these investors are still doing pretty well. They say only 5.3% of homes tracked by Redfin sold by investors sold for a loss. That's down from 13.7% in March of 2023. Now, they are calling out that this isn't anything significant. The level of purchases is still below even what pre-pandemic levels would see. It's sort of stabilized at a lower point now. So they say institutional investors are those who own 100 homes or more. They get a lot of attention in the housing market, but they're buying actually less than 2% of all the homes. That's according to data from John Burns Research and Consulting. Investors of all types and sizes in 2024 have purchased about 25% of all homes sold. So that suggests that the majority of the home buying by investors is actually coming from those small and medium-sized groups. And anytime we post anything on social media, primarily TikTok, where we're talking about an investment property or anything related to investors, there is always a lot of commentary on how institutional investors should be banned and they've ruined the housing market. But it's interesting when you see these numbers, if they're really only purchasing less than 2% of all homes, I think that would be a surprise to a lot of people. Now, that said, things have changed quite a bit over the years. So they say in 2002, investors made up only 12% of home buying activity. And over the last 20 years, that's obviously increased to about 25%. As far as locations, they call out that investors today aren't necessarily ramping up purchase activity in the Sun Belt, which is where they flocked to in 2020, 2021. Now California is seeing a lot of that. Markets like San Jose and Oakland. I thought that was interesting. It isn't what I would expect, but apparently that's what's going on. So let's look at what's going on with investor purchases in Phoenix. So this is from the Cromford Report. Percentage of home sales by intended use. So this isn't perfect, but based on the data they can gather, this is showing the percentage of intended use for different types of purchases. Obviously, we have our primary owner occupied being the largest chunk. The investor is this pink line here. And for Q1, we were at 13.9%. This is obviously much lower than it was during those pandemic years. So going back to 2021, we had 19% investor purchases, around 20% there, 21%, and that was in Q2 of 2022. And then, as we know, things all kind of tapered off from there. But that seems to be the largest share of investor purchases that we had during that time. So things have gotten back to a more normal range with about 14%. If we go back to, 2015, 2016, we were around, it looks like, between 10 to 12%. So we're not too far off of that now. Now, as the year started, we saw a lot of strength come into the market where our supply remained low and our demand started to really increase before those interest rates went back up towards the end of February. And now we're starting to see the changes hitting the market because our Cromford Market Index is truly in a balanced market now and has been going down quite a bit. So today we're at 107.7. Anything between 90 to 110 is considered a balanced market. Demand is at 79.1. This has gone down slightly. And supply is at 73.5. That is slightly climbing. So if we continue to see our supply go up and our demand go down, we'll hit 100 on the Cromford Market Index and be in a truly balanced market. Now, as you guys know, it varies city to city, so not every city is in a balanced market. For instance, Chandler is at 209.8 on the Cromford Market Index. That means that they are in a seller's market. But month over month, they have seen a change in a direction away from a seller's market. It's lost some momentum by 5%. And so it's weakening a little bit, albeit still in a seller's market. So Fountain Hills is also up there and Gilbert is also up there. The balanced markets that we have is really Goodyear and Surprise. Everything else below here is a buyer's market, but you'll notice there are a lot more red arrows on this chart than there have been in the last few weeks. The overall change month over month, the average was 0.1%, and last week it was 0.8%. So we're just seeing this lack of momentum for most of these cities. The only one that had a lot of strength was Fountain Hills with 20%, 20% change in the direction favorable for sellers. So that's what's happened in Fountain Hills. A lot of these other cities we're seeing are just starting to lose that strength for sellers, and buyers are gaining a little bit more ground in those cities. Now, I thought it'd be interesting to see what the graph looks like because we see those dials every week, but we don't always see the bigger picture. And so this is what our year has looked like. As I said, we started off pretty hot at the beginning of the year and then just slowly started to come down. And as we got into April, you can see we had a bigger dip and we've just kind of been tracking downward closer towards balance. Now, if we look at where we were at last year, we were much stronger. We started off the year in the same way, stayed pretty strong until midway through the year, and then things started to taper off and took off again at the end of the year. So it will be interesting to see where we head with this CMI for the rest of the year, if this is going to continue downward or if we're going to kind of level out. The more this goes down, the closer we get to a buyer's market. So every few weeks, we'll take a look at this chart and see what it's starting to look like, how close we are getting to balance, or if we're just kind of cruising along. Now, every week I've been sharing the contract ratio, so let's take a look at that as well. We're seeing a lot of green here, which is really that like balanced, warm type of market. There's a little bit of yellow, but you may notice there's a bit less yellow than there was a couple weeks ago when I first shared this. So we can actually go back in time here, which is what I love to see, and we can compare. So if let's just go back about a month ago, everything was a little bit hotter. You can see a lot more of that yellow and red throughout the valley. And then, where we're at today, we're seeing a lot more of those cooler zip codes, cooler colors, the green and blue in some areas. We still have a few areas that are hot, primarily the East Valley, some of the West Valley areas. But for the most part, things have cooled off, and you can really see that in this overall map. Now, if you're curious about what the contract ratio is in your zip code, I can actually pull out information. All of this is by zip code. So check the description below. I have a link where you can request that information. We also have some awesome resources for buyers and sellers. If you want an instant home value, if you want to search our MLS for homes for sale, all of that is in the link below. So make sure to check that out. And I'm going to see you next week on the next market update.